Dr. Michael Burry, yes, you likely recognize him as Christian Bale's role in The Big Short, has arguably been one of the most captivating value investors to monitor over the past 5 years. From his initial prediction about the housing crisis in 2008 to his more recent investments in GameStop before its meteoric rise, his support for Chinese technology firms prior to their surge, and not to mention his remarkably precise forecast of significant post-COVID inflation in the U.S., when inflation was scarcely at 2%, the man has been exceptionally intriguing to observe. However, over the last couple of years, he's gone completely silent. He's deactivated his Twitter account, refrains from interviews, leaving us with only one method to track his activities: his 13F filings, the quarterly portfolio disclosures that major investors are mandated to submit. Just last week, Burry released his updated 13F filing for Q1 2025, and it contains some very surprising actions. Michael Burry has divested all but one of his equities, but it doesn't end there. He has also initiated put option positions, wagering against the very stocks he possessed merely a quarter earlier. How's that for a complete reversal? So, let's examine everything Michael Burry executed in his latest 13F filing and what insights we can derive from it moving forward. Firstly, let's consider the 13F filing from the conclusion of last year. Burry maintained a robust portfolio valued at $77 million, encompassing 13 holdings. Some of the most substantial positions were in Chinese tech companies like Alibaba, Baidu, JD.com, and Pinduoduo. These firms had been consistent fixtures for approximately 2 years, persuading many, myself included, that this was a long-term investment in China's broader economic recovery. These were solid companies, merely suppressed by China's overall economic conditions, so retaining them long-term appeared advantageous as the nation rebounded. However, turning to the most recent 13F filing for Q1 2025, we observe a very significant shift. His portfolio has contracted from $77 million to just $13 million, as he literally liquidated every single company except Estee Lauder. The rest are gone: Alibaba, JD.com, Baidu, all eliminated. Thus, Burry has become exceedingly pessimistic within just 3 months, seemingly unwilling to hold anything at present. But here's where it becomes even more intriguing. If we examine Burry's options positions, we notice that he's also acquired put options, active bets against the 4 Chinese tech stocks he was supporting merely 3 months prior. He initiated put option positions against Alibaba, JD.com, Pinduoduo, and Baidu, as well as other companies like Nvidia and Trip.com. So it's not merely that he's withdrawing from the market due to recent volatility. He's actively betting against these 6 companies, 4 of which are the Chinese tech firms he was endorsing just 3 months earlier. What could have prompted Burry to undergo such a swift change in perspective in such a brief period? Well, consider what occurred during January, February, and March. President Trump initiated a substantial trade conflict with China. Following Liberation Day, Trump declared comprehensive tariffs of up to 67% on a broad array of imports. China retaliated with their own tariffs on U.S. goods, reaching 125%, and the U.S. responded again, increasing tariffs on Chinese goods to 145%. While recent developments indicate a 90-day pause, for Burry, who had been long on Chinese tech firms, this evidently altered the landscape. These were no longer ordinary stocks. They were ensnared in a political skirmish. Tariffs can dampen consumer demand, compress profit margins, and instigate a series of regulatory challenges. Add to that the persistent risk of U.S. delisting threats, capital controls, and negative sentiment toward Chinese equities in the West, and suddenly the potential upside for these businesses seems less compelling. In fact, if one were pessimistic about global trade or apprehensive about geopolitical escalation, Chinese tech stocks might be the primary candidates for shorting. Judging by these put options, it appears that's precisely Burry's perspective. It's peculiar. I don't believe Burry views these stocks as poor businesses, not in the slightest. I don't think his assessment of these Chinese tech companies has changed from 3 months ago. He simply perceives the geopolitical environment as having shifted, and that's sufficient for him to not only exit these stocks, but actively bet on their decline. And thus far, this likely represents a prudent bet by Burry. It's challenging to determine because we don't know the strike prices, but assuming he purchased these put options in March, coinciding with Trump's tariff rhetoric, he would have likely profited from the Alibaba, JD.com, Pinduoduo, and Baidu puts. This also presumes he sold at some point shortly after the Liberation Day turmoil, which I surmise he did, considering his tendency to capitalize on short-term gains when available. Of course, I can't confirm that. Unfortunately, there's no way to ascertain Burry's exact moves, as we only receive these updates every 3 months, and we don't even know the strike prices. But that's my best estimation. Beyond the put option contracts against the Chinese tech stocks, Burry also bet against a high-performing stock, Nvidia. On paper, this seems logical, with the company trading at a price-to-earnings ratio of 46. However, I don't know if I could bet against that stock, given both its impressive business performance over the past few years, that's undeniable, and the hype surrounding it. The final company he holds put options against is Trip.com, which you might not be familiar with. It's another Chinese enterprise. Yes, they have global operations, but they're headquartered in Shanghai and listed on both the Hong Kong Stock Exchange and the Nasdaq. Therefore, I believe this put option position again relates to the trade war narrative I previously discussed. That's the significant news regarding Michael Burry's actions over the past 3 months. The next point to address is the one stock that remains, Estee Lauder. The lipstick index hypothesis, for those unfamiliar, was a term coined by Estee Lauder's chairman, Leonard Lauder, during the early 2000s recession. It refers to the notion that during economic downturns, consumers tend to indulge in small, affordable luxuries like lipstick instead of expensive items. They still desire indulgence, but are priced out of significant splurges, so smaller treats become more popular. This could be part of Burry's thesis. However, I personally don't attribute much weight to that. The reason is that the company's performance has been lacking, revenue has been declining, and net income has turned negative. One of the primary reasons for this is diminished demand in the Asia-Pacific region, particularly China, and disruptions in travel retail channels, such as duty-free airport stores, cruise ships, and international train stations. To address these challenges, the company has initiated a comprehensive restructuring effort, including the elimination of up to 7,000 jobs as part of a multi-year cost-saving plan. Management has also launched a profit recovery strategy aiming to increase operating profit by $1.44 billion by 2026. Leadership is also undergoing changes, with their long-serving CEO stepping down and a new CEO assuming control. Honestly, if you ask me, I don't think Michael Burry is delving too deeply into this. I believe he's more interested in the fact that, following its substantial decline, Estee Lauder is now trading at levels not seen in nearly a decade. The company is down 82% from its peak at the end of 2021, and knowing Burry's contrarian nature, I think he perceives a classic value opportunity, a company with a portfolio of strong global brands like MAC, La Mer, Clinique, and Estee Lauder itself, presenting a cigar butt style opportunity, where the company has been so heavily discounted that Burry is seeking that one last profitable puff. Burry is well known for capitalizing when the market overreacts to short-term issues. Based on Burry's investment, it appears he's betting that, with a turnaround plan underway and new management, Estee Lauder might offer a favorable risk-to-reward ratio. That said, I want to clarify. Should Estee Lauder experience even a modest increase in stock price, it wouldn't surprise me at all to see it removed from Scion's portfolio in the next 13F filing. From observing Burry's 13Fs over time, I think he's hoping for just a hint of positive news to prompt investors to believe in a turnaround. So, what's the overarching lesson when examining Michael Burry's 13F filings? As I've emphasized before, there's limited actionable insight for long-term investors. While you all enjoy updates on Burry's moves, and I'm glad to provide them, it's crucial to remember 2 key points. First, Burry consistently demonstrates that, although he employs a value investor's mindset akin to Buffett's, his actions often mirror those of a short-term trader. Second, 13F filings are disclosed 45 days post-quarter, meaning the information is somewhat dated upon release. This combination isn't ideal for long-term investors seeking timely insights. Unlike Buffett, whose disclosed positions often indicate enduring investments, like his 2016 Apple acquisition, Burry's holdings can be fleeting. Given the 45-day lag, It's plausible that Burry has already exited these positions, especially if market conditions have shifted or trade tensions have eased. It's also worth noting that Burry likely doesn't perceive these Chinese tech firms as fundamentally flawed. His previous 2-year investment in them suggests a belief in their long-term potential. However, geopolitical dynamics can prompt rapid strategy shifts. In summary, while it's intriguing to observe Burry's near-total portfolio overhaul and strategic pivot within a quarter, it's essential to approach such information with a discerning eye. If you appreciate these 13F updates, please like the video. I'm eager to hear your thoughts on Michael Burry's investment approach. Do you monitor his moves, or do they hold little sway over your strategy? Share your perspectives in the comments below. Thank you for watching, and I'll catch you in the next video.